Welcome to Capital Link's company presentation series.
Welcome to Capital Link's corporate presentation webinar series. In this series, senior management of listed shipping companies provide an update of their operations, business development, strategy, and sector outlook. I'm Nikos, president of Capital Link. Capital Link is an investor relations firm also active in event and conference organization, and we work with several private and publicly listed companies, including companies featured in this webinar series. As noted in our disclaimer, these presentations are purely for informational and educational purposes. They do not constitute investment advice or advice of any kind, and obviously Capital Link bears no responsibility for them. Today, we have with us the senior management of CPLP, of Capital Product Partners. We have Mr. Kalogiratos, Chief Executive Officer, Mr. Nikos Kalapotharakos, Chief Financial Officer, and Mr. Spyros Leoussis, Chief Commercial Officer. The whole session will be 45 minutes. We will start with a brief slide presentation, followed by a live Q&A session. Please submit your questions through the Q&A button at the bottom of the screen, and you can also email your questions to us at webinars@capitallink.com. Thank you for joining us, and now I will turn the floor over to Jerry.
Good morning, everyone, and thank you for joining us all today. Thank you, Nicola, for hosting this webinar. We will be more than happy to take questions from you shortly. But in the meantime, we'll start with a corporate presentation that I will share on my screen. Apologies for this. This is, sorry, quick second, there you go. Okay, here we are. CPLP owns today, it's a maritime L.P. and owns today a diversified modern fleet that includes 6 latest generation LNG carriers, 14 container vessels, and 1 dry bulk Capesize vessel. Its business model dictates that we employ all our vessels under medium to long-term period contracts, and currently the remaining charter duration is just short of 5 years and reflects 1.2 billion of contracted revenue. We pay a distribution and to our common unit holders, and we have done so since our IPO in 2007. Our investors file a 1099 tax form, and currently the distribution guidance is 15 cents per quarter, which is an implied 4% annual distribution yield. In addition to that, we return capital to unit holders through an active common unit repurchase program, which is in place for up to $30 million. Last year, we purchased $4.5 million worth of shares, so there is additional capacity for this year and the next. We maintain a strong balance sheet, and we don't have any significant debt maturities until the end of 2026. We have a significant pipeline for growth, including additional LNG carriers and container vessels. And our sponsor, Capital Maritime and Trading, one of the largest private shipping entities out there, has been very supportive of the partnership throughout the years with Dropdown Opportunities, participating in equity offerings, and it has been also acquiring units in the market over the last few quarters. Now, a few words about our business strategy. We focus on modern assets, and as I discussed earlier, with medium to long-term charters in place, we don't take any spot exposure. So we also like to diversify our revenues by having a foot in different industry segments. So currently we have really exposure in the LNG and container segments, which are not correlated. And at the same time, we have a diverse customer base. We maintain a strong balance sheet and we have a conservative debt amortization policy. We have now a new leg in our business strategy, which is set to invest in modern, eco-friendly vessels that will reduce the partnership's environmental footprint over time. And finally, we invest in segments where we believe there are strong fundamentals, such as the LNG and container market. A few words about our current fleet. The fleet comprises 6 brand new LNG carriers of latest generation, which are which is quite important, especially in environment with very high LNG prices. We have 14 containers, Panamax and post-Panamax containers, and 1 odd dry bulk Capesize vessel. It is a modern fleet with an average age of 8.2 years, which compares very favorably with the industry average fleet age. Here you can see the charter coverage and duration on a per vessel basis. What you will see is that all our vessels, with the exception of the dry bulk ship, have long-term charters in place. Some expire in 2023-24, but many run from until 2025 up to 2027. We have staggered expirations, which is quite important. So not everything comes up for charter renewal at the same time. When you look at our charter coverage at the bottom of the slide, you'll see that effectively we have almost all of our available days covered until 2024. And even for 2025, more than 50% of our available days are covered. Here you see the contracted revenue backlog. It's 1.2 billion, and you see how this is staggered over the next few years. Importantly, we have also a high quality and diversified customer base with household names as our counterparties, such as BP, Semir, NSC, or Hapag-Lloyd. And our biggest exposure is to energy major BP. Overall, over the years, we have had an excellent financial performance. We have been able to raise equity and grow since we went public in 2007. Importantly, we have never stopped paying distributions to our unit holders. We have paid distributions non-stop for 59 consecutive quarters, corresponding to just short of $1 billion. We have a significant asset base with $1.9 billion in total assets. Very important is that in terms of the balance sheet, we have never restructured debt, delayed service payments, or even asked for a loan agreement waiver. And I think this is very important, given also the volatility of the underlying markets. At this point, let's say at year end, net debt to fleet fair market value was around 45%, which is a very reasonable leverage and gives us the space to do more. And as we also highlighted at the beginning, we don't have any significant debt maturities until the end of 2026. In addition, as you can see from the two charts on the right-hand part of the slide, we have been growing consistently our revenues and EBITDA both by taking advantage of market fundamentals, but also by adding additional assets to our asset base. One significant transaction that has transformed really the partnership is the one that took place in the second half of last year. We acquired 6 brand new LNG carriers of latest generation, so-called XDF LNG carriers, for a total consideration of $1.2 billion, which translates into just short of $204 million per vessel, which historically is a very good entry point. All vessels have long-term contracts with a remaining charter duration of about 5.7 years, just short of $70,000 per day. You will really see the impact of this transaction, if you want, in 2023. As in 2021, we had only 377 operating days from these vessels, as most of them were delivered towards the end of the fourth quarter. Whereas in 2022, we expect to have almost 2,200 days. One important aspect of this transaction is also the reduced environmental footprint of the LNG carriers. These are dual fuel LNG carriers, so they can burn both fuel oil, but importantly also natural gas as fuel. Given also their environmentally friendly design, we expect them to reduce the environmental footprint of the partnership as a whole. At this point, I would like to pass the floor to Spyros, who will take you through the container and LNG market fundamentals.
Good morning for me. So for the container charter market, we have experienced an extraordinary positive momentum in 2021 and in the start of 2022, with freight and charter rates surging to record highs. Indicatively, we say that the Clarkson Container Charter Rate Index stood at 415 points in February, up 330% since the beginning of 2021. The market was driven by a range of factors, mainly strong demand, exceptional freight rates, severe logistical disruption with port delays, and the trend towards longer periods that has restricted tonnage availability, especially in the larger sizes. The outlook remains extremely positive for 2022, with very low newbuild deliveries, only 1 million TEU in 2022, and vessels that have been fixed on medium to long-term charters in 2021 should keep tonnage availability very limited for 2022. The demand growth is expected to outstrip supply growth for a second consecutive year. Overall, demand growth now expected at 3.9% for 2022, with supply growth forecast standing at 3.6% only. The container vessel order book stood at 24.9% at end February 2022, with new building activity having decreased since in the early fourth quarter 2021, due mainly to the very high new build prices that we are seeing these days. Many of the larger container lines have decided in terms of the Ukraine and Russia dispute and war, effectively. Many of the largest container lines have decided to suspend bookings to and from Ukraine and Russia, despite there is no, Jerry, I think you have this, okay. Despite being that none of these countries is actually a key market for Russia, for the liners. We move on to the next slide with LNG market developments. On the LNG side, we are seeing a very strong long-term market, with current rates standing at around $70,000 per day for a DFDE unit and $85,000 per day for one of our vessels, which is two-stroke vessels, the modern, let's say, fleet, for a 5-year TC rate. We are seeing a very strong demand on the commodity side due to the lack of gas in Europe, because of Russian closing down pipelines since let's say mid 2021, but obviously continuing now with the situation. The Russia-Ukraine conflict, long term, we expect to favor LNG transportation, as it demonstrates that LNG is a strategically independent choice for gas producers and for gas consumers as well. So, for example, like Europe is now heavily relies on gas import from pipes from Russia. We expect this to change. We expect more infrastructure to be developed for imports of LNG, both in Europe and in Asia. New liquefaction capacity is expected to double by 2027. And indicatively, US LNG exports are projected to grow by 30% in 2022. The order book currently starts at 31% of total fleet, with shipyards now marketing slots for 2026, as there is very limited capacity for 2025. Following a drop in 2019-2020, new build orders have now reached an all-time high, with 85 orders placed in 2021. With most of them against their long-term employment. Only a handful are against the speculative orders. We expect new build activity to continue the bullish trajectory on the back of new projects development, especially from gas coming from the US. In terms of asset prices, we are seeing a continuous rise on the asset prices, with now around $220 million per vessel for high spec LNGs, and on the back of increased demand, we expect this trend to continue. As we are seeing an increased focus on greenhouse gas emissions, mainly methane emissions, we expect older LNG carriers to phase out faster than expected in the market, effectively giving a significant advantage for new tonnage like ours. And with this, I'd like to pass back to Jerry to continue the presentation.
Thank you, Spyros. In view of the strong fundamentals of the LNG market, as well as the container market, we believe that both segments are segments where we would like to grow further. The partnership is at a place where it has been growing its asset base, as we discussed, at a fast pace, and at the same time increasing its free cash flow generation. And as a result, over the coming quarters, we expect that with the support of potentially refinancing that we can do on the back of our container fleet, we will have additional liquidity to deploy. On the back of this, when it comes to growing our asset base, there are assets that are with our sponsor, which potentially are a very good fit for our business model. These include a number of LNG carriers that you see on the slide, and as well as container carriers. The first one on the table, which is the table of the fleet that we have a right of first offer on, which is a right we obtained when we acquired the first batch of LNG carriers. You'll see that the first LNG has already secured employment of up to 9 years, while there are 3 additional 13,000 TEU container carriers which have employment in place for up to 16 years. These 4 ships that have employment in place and fit our business model are good candidates for growth down the line. And we will be aiming to see whether we can add those to our fleet before year end. In addition to those ships, and depending on our ability to raise accretive capital, there are also additional vessels, such as the other LNG carriers that you see on the slide, that once they have employment in place, could be also candidates for further drop down. I think that begs, of course, the question as to how we deal with acquisitions and what is it that we want to achieve. I think that the track record of the partnership in terms of past acquisitions speaks for itself. So what we do is target those assets that have employment in place, be it second-hand or new builds, and across different segments. We have been able to achieve mid-teens levered equity returns, in certain cases much higher. And we have been able to achieve that without let's say, exposing our unit holders and the partnership to the usual volatility of the shipping markets. So at the time of the acquisition, we make sure that the financing is in place, that long-term charters at attractive rates are in place, and we can deploy our equity accretively. In certain cases, we have not been shy of locking in good profits, as we did with 2 container vessels. As you see with the case study number 1, the Adonis and the CMA CGM Magdalena. These are vessels that we bought in 2015 and 2016 as new buildings. We acquired them when they had a 5-year charter in place. And at the end of their charter, we sold them as we got a very good offer, and that meant that we crystallized a gain of just short of 47 million and a levered IRR of 26%. Recent investments, like the 6 LNG vessels that we have acquired, or the 3 Panamax vessels that we acquired at the beginning of 2021. Depending on the exit assumptions, they are expected to return between 15 to 25% on the equity deployed, potentially higher if we find a better exit down the line. And as we deploy the equity across all these different investments, always making sure that these are accretive to our distributable cash flow, we make sure that we balance the returns between returning capital to unit holders, and that is done through common unit distributions, but also unit buybacks, but at the same time redeploying cash in growing our asset base. Thank you. I'll stop here and see if there are any questions from the audience. So starting with the first question, it's about the impact of the Russian-Ukrainian conflict to CPLP's operations, and whether higher bunker prices are likely to affect the partnership from a financial standpoint. I think what I was saying earlier is really the answer to this. Because of our business model, because we acquire good assets, modern assets with long-term charters in place, it means that we do not have any spot exposure. While in very good markets, like the ones that the container market is going through today, there might not be a lot of upside. There is also the protection from the significant downside that you see from time to time in our underlying markets. So, irrespective of the impact of the Russian-Ukrainian conflict, we do not expect any changes to our contracted revenues. Importantly, also because we employ all our vessels on time charter contracts, this means that our charterers pay for the bunker prices, for the fuel oil prices, and not us. So there is no impact on us financially, irrespective of where fuel prices go. And I would also add here that, as Spyros mentioned earlier on, the Russian-Ukrainian conflict, if anything, is expected to support the long-term fundamentals of the LNG industry, where we already have 6 vessels. I think, especially Europe, will make sure it diversifies away from Russian pipeline natural gas, and will make sure they can import more with LNGs. So overall, this bodes well for the LNG industry from on the medium to long term, and we have definitely exposure there, and we intend to grow it down the line. Another question relates to whether we will incrementally increase the common unit distribution, and whether we will resume the repurchasing activity of common units. I think, as we discussed in our last quarterly call, and as discussed also earlier on this webcast, the idea is that we will continue to balance growth with returning capital to unit holders. So we already have increased the distribution by 50%, from 10 cents to 15 cents, on the back of the 6 LNG acquisition that we announced in the second half of 2021. So a significant increase already of the common unit distribution. And as we continue to grow our fleet, you should expect to see incremental increases to our common unit distribution. Importantly, again, as we have announced during our last quarterly call, we have resumed our unit buyback program, and we will report on this on a periodic basis. Another question relates to when is our next charter expiration, and what are expectations with regard to that. Maybe if I was to go back to the presentation and this specific slide. As you can see, we have one vessel, the Cape Agamemnon, that trades in the spot market, but is a relatively insignificant part of our revenues. It's an asset that we have said before that we would look to potentially divest when the time is right. But really, our next significant charter expiration is the Akadimos. It's a vessel that will come off charter at the end of the first quarter, beginning of the second quarter. The vessel is today earns around $35,000 per day with O&E. Similar fixtures that are being done for similar vessels with forward deliveries are currently closer to $60,000-$70,000 per day. As we come closer to our charter expiration, we hope to be able to take advantage of this position and fix long-term at similar levels. The container market continues to be very strong, and demand for such high-specification vessels as the Akadimos is quite robust. Another question relates to whether we would be tempted to employ air lubrication systems in our LNG new builds. Spyro, I will maybe let you answer that, and also give a short summary as to the specification of our vessels and how this compares to other technologies, and how significant is that?
Sure. Yeah. I think it's important to understand all of our LNG new buildings have air lubrication. As is pointed out in the question, we actually believe that it's important to have the most efficient vessels in the water, and this has always been part of our, let's say, commercial strategy. Our vessels currently they have a very significant advantage against older generation vessels. As they burn less fuel, they have less boil off, and they can transfer more LNG. So I would say, based on the fuel consumption, the less boil off and the less LNG, we are talking about a unit freight cost differential of in excess of $50,000 to $60,000 per day versus the FDEs, which is the second, let's say, tier in the market. For steamships, obviously, this is a lot higher. I think, yeah, that's the main. Jerry, I'm missing something. Also, maybe in regards to the pipe, there's one. I can see one question regarding the pipeline cargo, the dislocation of pipeline cargo and the impact on the LNG tanker business. I take that.
Sure.
As we said previously, we believe that the long-term effect on the LNG market will be very positive, because it will mean that more LNG projects will be sanctioned. We're seeing increased FID activity in the States, and also in other places in the world, like Qatar. We expect to increase further, and in the Southeast Asia as well. We expect more LNG to come out. In the short term, it's I would say neutral to negative to LNGs, because we have to LNG transportation, because we have let's say allocation of cargoes to Europe rather than the Far East. So in terms of ton miles, let's say for the next year or so, we would probably be a neutral or even negative, let's say, effect in the market. And if in terms of our long-term contracts, they are all fixed, so we don't have any variable rates for let's say, for the duration of the contracts. So our next open vessel comes in a very, let's say, favorable time, which we think it's 2025, where we think we'll be able to, let's say, capitalize further on the growth of the LNG business in total. I think that's for me. I don't.
Thank you. I think there is one last question on why is CPLP not a pure play. I think it's a different business model. This is, I think, the value proposition. There is little or no exposure to any specific segment at any given moment in time. So it is really, for us, we try to deploy equity accretively in segments where we have conviction as far as the fundamentals are concerned, but at the same time, we make sure that we have visible cash flow generation with medium to long-term charters. I think this is really the differentiating factor here. and that's on the back of good assets and good customers. So this is not about exposure to any, or at least in the short term, to any specific segment, but more our ability to deploy equity accretively and return capital back to our unit holders, which we have done quite successfully for now more than 15 years. Thank you all for attending today, and Nicola, once again, thank you for hosting this webcast today.
Well, thank you, Jerry, Nikos, and Spyros. This webinar will be available for replay, upon demand, and our experience shows that we get a lot of replay views, and thank you for replying to so many questions, and was a very timely and topical presentation. Thank you very, very much.
Thank you.
Thank you.